Live at the Chicago Board Options Exchange is Judd Pyle of Peak 6 Investments. He has more than 15 years of experience analyzing, trading, and risk managing equity options. We'll find out why he says the S&P will bounce around the 1115 level this year. And also with us is Leo Grohowski, Chief Investment Officer at Bank of New York Mellon Wealth Management. Late last year, he warned that 2010 would not be an easy one for investors, and so far he has been right. So, Leo, we're going to start with you. You think we're looking at 1040 as a key level for stocks right now. Is that your target, or what we should be focusing on in the next week or month?
Yeah, I think that's the level that most technicians have been looking at, which would define sort of the bottom of the head and shoulders. And so it would be unfortunate to close below that 1040 level. Next stop, according to most technicians, would be sort of 1115, 1125. And I think for a lot of investors, you know, that 1,000 is a nice round number, unfortunately, on the downside.
And I know those technicians really key in on those levels, Leo, but let me ask you, so 1031 is where we are on the S&P. If we close below that 1040, I mean, will it be significant today, or do we have to kind of wait and see what happens on Friday?
I think you're absolutely right, Carol. I think Friday we've got a big payroll number tomorrow. What's happening is because of the ADP numbers that came out earlier today, we are seeing expectations reduced for the private number tomorrow.
Right.
And that's not a bad thing, because I think, you know, we don't want a disappointment going into the long weekend. But you're seeing a lot of churning. It's the last day in a quarter. There's a lot of window dressing going on. Bad quarter, last day in quarter, big employment number tomorrow. And starting next week, we've got 4 weeks ahead of earnings where 70% of the S&P 500 is reporting earnings.
And you think they're not going to do as well as they have been doing the past couple of quarters?
I think earnings are going to be up 40%. And that's the good news, right? What's been happening, this market has been resetting expectations, because I think from this point, earnings expectations are probably going to have to get reined in a bit.
So forecasts will be lower when they come out with their earnings reports.
I think that's right. I think you're going to see a more cautious outlook for 2011 than what is currently baked in to analyst expectations, where S&P earnings expectations, according to Bloomberg, are around the $95, $96 range. That's probably a little bit high for the economic outlook that we foresee.
I want to bring you into this. We haven't forgotten about you. So what did you make of the selling, particularly in the last hour here?
Well, I think that what Leo was talking about, and then Laura at the same time, you've got technicals driving a lot of the market, and what happens is, having broken through that 1040 level, that was support. It's now going to become resistance, but the big thing is, in the short term here, there just aren't a lot of reasons for people to take risk. And so, to Leo's point, hey, earnings are going to be up 40%, but what people are willing to pay for those earnings on a price-to-earnings basis has gone down a little bit. Now, I think in the long term, that's going to come back. That's why I think we're getting back to 1115 on the S&P, but it's going to take a while. And right now, the bears are in control.
Hey, Judd, it's Dominic here. I mean, Matt and Adam and I, we've talked to a lot of traders who basically have told us in not so many words that they're starting their weekends early and that they're getting out of things now. Maybe part of the reason why we saw the sell-off yesterday and some more of a sell-off today to kind of flatten out before the weekend. Right. How much is this going to really play into what's going to happen for Thursday and Friday if nobody's going to really be around trading, so to speak?
Well, I think people are going to have to be around watching things, because this jobs number is still a huge deal. But it goes right, it reemphasizes the point that there's just no reason for buyers to step into the mix right now. They'd rather give up 1, 2, 3, 4% than get beat to the downside by another 10% on a bad jobs number. So you're right. You throw the 4th of July in there, people squaring positions, nobody's wanting to take risk, and as people decide that they have to sell, the buyers are just not prevalent.
Leo, I wonder, when there's no reason for buyers to get in there and nobody is buying, isn't that when you want to be picking things up, though? I mean, isn't that when valuations get to a level where you want to, especially if you're a long-term investor, lower your DCA?
Short answer is yes. And always easier said than done, because when you start seeing brackets around your weekend and your month-end statements again, particularly after we had an 80% move from trough to peak in late April, I think a lot of investors, to Judd's point, are back in capital preservation mode. And maybe I'm leaving some upside on the table, but particularly in advance of a long weekend, let me just keep what I have for now. That usually means that opportunities begin to bubble up. And look, we have an $80 earnings forecast for the S&P this year. That's now below consensus. The market's trading at now less than 12 times those earnings. And normally, markets don't trade at less than 13 multiples when 10-year treasuries are at 3% or less, and inflation is at 1%. So we've been calling this market reasonably valued. It's at least reasonably valued, but it's a time you have to think bottom up because the top-down picture has a lot of uncertainty.
Hey, speaking of uncertainty, the situation of those sovereign debt nations is certainly uncertain at this point. One of the things that seemed to kind of play into the market trade, Judd, was Moody's possibly downgrading Spain again. I mean, what is it that's really driving the market? Is it the concern outside of our shores, or is it the concern about the economic recovery here in the U.S., or a little bit of both?
It's definitely a little bit of both, because you add into that the news that we had out of China yesterday,
right,
which pushed us down a ton. So the global impact of this entire thing is huge. You talked about the tech sector late in your earlier segment, and part of the reason that those tech shares are getting hammered is because the big cap tech stocks get a large portion of their revenues from overseas. So if people are concerned that that's going to dry up, that's why those stocks are selling off. I don't believe that that's what's going to happen. And to get back to Leo's point, I think why we can have a decent July is because we're in an information vacuum here. When you start to get these earnings numbers coming out, starting with Alcoa July 12th, that would be the catalyst that gives the buyers a reason to step back in.
Well, and $80 wouldn't be bad for this year, would it, Leo? I mean, you say you're under consensus, but a lot of people are now so concerned about the picture in Europe and so concerned about the Fed coming out and saying, by the way, this recovery is still not really self-sustaining. It makes a lot of people fearful, and if you still hit $80, that's not bad for 2010.
It's not bad considering we were at less than $57 for 2009. So it's a good year for earnings. I think the problem is investors got pretty comfortable with the notion of not only recovery but economic expansion. And here's where I think we need to rein in expectations. We're in a recovery, but we're really not in an expansion with unemployment still between 9.5% and 10%.
I'd expect it to stay there for a while.
And it's going to stay there because of the uncertainty and because of the headwinds. We talked to a lot of CEOs and CFOs who are going to be cautious about hiring.
Hang on, Judd. I want to get your take on unemployment, because you seem fairly bullish or optimistic. And I know, though, that traditionally guys in Chicago are worried very seriously about the labor market more than they are here in the Northeast.
Well, I think that, I think that people are getting back to work, and I think that after some bad numbers that we've had, I think that we could get a little bit of outperformance. One other thing I wanted to point out is that bonds have outperformed equities a ton in the last month to a quarter. It's something in the neighborhood of 15%, which is absolutely ginormous. And so when you add that back in, I think we could get some asset allocation eventually where people start to sell bonds and pile back into equities, because as Leo said, rates are ridiculously low.
Jules, did you want to, did I steal your thunder there on the employment question?
Well, I was actually going to ask Leo if there's anything that would change his mind about the outlook for stocks. I mean, even if you're looking at our earnings at $80 by the end of the year, you're still not sounding terribly optimistic about the direction of stocks. Is there anything that would change your mind?
Well, I think it's just clarification of some of the uncertainty, and I do think that financial regulatory reform, one of the big clouds that's been hanging overhead. So we'd be buyers before we'd be sellers, mainly on a valuation. So I don't want to come across as too
so
negative.
Optimistic about 2011.
No, well, look, if earnings aren't 95, we're still expecting, and this is a key point, we're still expecting global economic growth of between 3 and 4%. And I think when a lot of investors come in, it doesn't feel that way. Now, a lot of that's going to be driven by developing economies, not developed economies. We do have our challenges, but we do have economic growth and earnings that will follow.
All right, Leo, thanks so much for joining us. Leo Grohowski there from Bank of New York Mellon. Judd Pyle from Peak 6 Investments, thank you so much for joining us.